Hello. Good evening.
Screen share off. Mute ആണോ സാറേ?
No, കേൾക്കുന്നില്ലേ?
കേൾക്കുന്നില്ല.
Not audible. One second. Is it audible now?
സാറേ
Audible? No. Can you hear?
നെറ്റ്വർക്ക് എന്തെങ്കിലും ഇഷ്യൂ ഉണ്ടോ?
ഇല്ല.
ഓക്കെ. എനിക്ക് എന്റെ പ്രോബ്ലം
Okay.
ഓക്കെയാണ്. വീഡിയോ ഓക്കെയാണ്, ഓഡിയോ ഓക്കെയാണ്.
It's okay.
ഓക്കെ.
I can start straight away at 7:30, no?
Sir. Starting on 7:30. There will be no introduction.
Okay.
Straight away start.
Screen share you have enabled?
അല്ല, എനേബിൾഡ് ആണ്. ഞാനത് ജസ്റ്റ് ഒന്ന് ഇതിന്റെ ലൈവും കൂടി പോകുന്നതുകൊണ്ട് ഞാൻ സ്ക്രീൻ ഇട്ടുന്നതാ.
Okay. Only very few have joined. 5, 6. Harry, should I wait for a few minutes or I can start? Should
2 minutes. 2 minutes. Then we'll be start.
2-3 minutes I'll wait. Okay. Yes, good evening, bankers. Good evening to all. I am James, one of the senior faculties of IBS. And today, I'll be handling the numerical part of your retail banking and wealth management paper. Generally, they used to ask questions for marks ranging from 10 to 20. And when this topic was part of CAB. But now, see, the current year, a lot of changes had taken place. The feedback which we received from the candidates, it was mostly in the previous paper, even accountancy paper, mostly it was theory oriented. So we can't predict about the pattern of the exam which IABF is going to give to you for this paper. Sometimes it may be theory oriented. At the same time, sometimes it can be a lot of numericals also. So we cannot have a clear idea until you write the exam. So well prepared, be prepared for to face all the eventualities. So don't leave any of the portion topic untouched. A lot of numericals are there in this area. Number one, it is interest calculation, then annuities, then depreciation, retail loans, then credit card interest dues, floor space index, then capital gain tax. So many areas are there. From all these areas, there can be questions, but we can't say what are the questions they are going to ask. I'll be touching, I'll be solving one or two questions from each of the topic. I'll be explaining the concepts also, so that you can answer any of the questions which comes. It's an area where you can easily score the mark. The session is divided into two parts. First 1 hour, then I'll give you a break. Then 15 minutes break. The second session start at 8:45, and then that will be over by 9:45. So that's the planning. Another request to all of you: please keep your mic in mute position. I recommend you to put your comment on the chat box. If you want something clarification, you can write in the chat box, because we expect a good number of participants for this session. So just in between, if you're talking, and it may distract the attention, and others also may not be able to hear it properly. So one request is, please keep in mute position your mic. And after a topic, if you have a doubt, you can use the chat box and write in brief what you wanted. Anything extra or one more detailed explanations needed. That's the best thing you can have it, to avoid the distraction in between. So let me go to the topic. So these are the topics I would like to cover in the first session: interest, annuity, EMI, and depreciation. We'll go to the interest calculation. I'll go in a quick way, because these areas are familiar to, I think, most of the candidates, almost all. In interest calculation, there are two methods of computing the interest. One is the simple interest, and another is the compound interest. And in simple interest, there are two formulas. One is the simple interest is equal to I is equal to P into N into R, where P, N, and R principal, number of years, and rate of interest. Number of years will be, N will be in number of years, and R will be in percentage. You can have another equation from this, the total amount, A. A means it is P plus I, means the cumulative amount, principal plus interest, that is P into 1 plus NR. So this is one formula. This is another formula which you are supposed to remember in the case of simple interest. Next is compound interest. And in compound interest, a formula which you have learned in your schooling, it is A is equal to P into 1 plus R, the whole raised to n. Here, A is the cumulative amount. It's not compound interest. It is the cumulative amount. Cumulative amount means interest plus principal. And P, the principal, R, the rate of interest, and N, the number of years. So in the question, if they ask interest rate 5%, interest rate 8%, nothing is mentioned about whether it is simple or compound. they just mentions interest, means it is simple interest. Again, if they say compound interest without mentioning the compounding rest, what is the meaning of compounding rest? Compounding rest refers to the period when the interest is added to the principal. For example, the compounding rest can be annually. The compounding rest annually means every year. At the end of first year, interest will be added to the principal. Suppose the principal is 100 rupees, the interest is 10%. Then at the end of first year, 10% of 100 rupees, that is the interest is 10 rupees, that will be added. So the principal becomes 110 at the end of first year. So the second year, this is the first year interest. And second year, you have to calculate 10% of 110 rupees. That means it is 11 rupees. So second year interest will be 11 rupees. So second year end or third year, the amount becomes 121. And in the third year, the interest will be calculated for 121, not for 100. Whereas in the case of simple interest, the interest will be same every year. If it is 10% and principal is 100 rupees, at the end of first year, the interest will be 10 rupees. At the end of second year, interest will be 10 rupees. At the end of third year, again, interest will be 10 rupees. And it goes like that. So this is the difference between simple interest and compound interest. And in the case of compound interest, depending upon the compounding rest, the interest will be different. Now, compounding rest means it can be annually. Annually means every year at the end of first year, interest is added to the principal. Again, the compounding rest can be half yearly. If the compounding rest is half yearly, it means that every half year, at the end of 6 months, interest is calculated. In this case, 10% half year rest, if that is given. That means 100 rupees, you have to calculate 6-month interest at 10%. 10 rupees is for 1 full year. So half of year, the interest will be 5 rupees. So this will be added 105. And next 6 months, you have to calculate interest on 105 rupees. And it goes. Therefore, half year means interest will be added to the principal every half year. Again, if the interest is compounded quarterly, that means every 3 months, every quarter, interest will be added to the principal, and that interest start earning interest. Again, it can be monthly. Monthly means every month, interest will be added to the principal, and interest will be calculated on that interest also. And here, see, now, if the question is compound interest, nothing is mentioned about the compounding rest, it means it is annually compounding. Otherwise, they will mention whether it is half year or quarter or monthly. And another point to remember, if the compounding rest is half yearly, and then for rate of interest and number of years, it undergoes a change. Suppose it is 10% and number of years is say 3 years. And if it is half year, then for 10%, R takes the value 10 by 200 and N takes the value 3 into 2. That means it is half year. You have to divide the rate of interest with 200 and number of years multiply with 2. If it is quarterly, rate of interest means rate of interest divided by 400 and N will be 3 into 4. Again, if it is monthly, the rate of interest you have to divide with 1200 and the number of years you have to multiply with. So if it is 3 years, 3 into 12 means 36. So this is the point to remember. This is very important aspect. You look at the question, what is the compounding rest? If the compounding rest, nothing is mentioned, only compound interest means it is annually compounding, rate divided with 100, number of years you can take it as it. 5 year means N is 5. A rate of interest 10% means it's 10% means 10 by 100, 0.1. If it is half year, you divide with, instead of 100, you divide rate of interest with 200 and multiply number of years with 2 because an year means it has 2 half year. So 5 year means 10 half year. 3 year means 6 half year. So this is the 2 important aspects you should remember in interest calculation. So these are the formulas. You can just go through it. Next is all I have explained. Next is annuity. Annuity, there are two types of annuities. One is the end of the period annuity, and second is beginning of the period annuity. Before going to the two different types of annuities, let me explain what is meant by an annuity. An annuity refers to a series of either receipt or payment of a period of time. So here the amount is uniform. You cannot keep it, you cannot change it. If the amount is fixed, I mean, it should be uniform, and there will be a definite period. And that procedure, whether you receive or you pay over a fixed period, a certain amount, that is called an annuity. An example for an annuity is a recurring deposit in your bank. Most of you are familiar with the recurring deposit. In the case of a recurring deposit, suppose a customer comes and open a recurring deposit, say, I would like to open a recurring deposit for 1,000 rupees per month, and I wanted to make it for a period of 5 years. So what you will do, you will ask the customer to fill up the forms, and then the customer has to pay 1,000 rupees and open the deposit. That means in the month of October, any day he has come, suppose today he had come, it means 1810, he has opened a recurring deposit by depositing 1,000 rupees. Now in the month of November, any day during November, he has to come and deposit 1,000 rupees. And then in the month of December, he has to come and deposit 1,000, and so on. For a period of, say, 5 years means 60 months he has to deposit. This is an example of an end of the period annuity. So end of the period annuity means the amount, the uniform amount which the depositor has to give to the bank can be on any day, or it can be on the end of the day, end of the period. If it is a monthly, end of the month. That means even though he had opened the recurring deposit on 1810, the installment for November, he can remit on any day, but not after 30th November. So latest by 30th November, he has to deposit the RD amount. Then only you will not charge any penal interest. Suppose the customer comes in December and requests for making the remittance of November, you will be charging a penal interest for that. So this is an example of end of the period annuity. So end of the period annuity means the amount which is to be paid, that has to be made remitted at the end of the period. If it is monthly, end of the month. It need not be monthly. The annuity also, the periodicity can be monthly, quarterly, half yearly, or even annually also. So in the case of an annuity, look at this case. Suppose a customer opens this recurring deposit for 1,000 rupees, and let us assume you are paying 6% interest to the customer, and he is opening for, say, for a period of 5 years. So here, this uniform amount is represented by the letter A. In the case of annuity, A refer to or represent the uniform amount or the annuity. We call the annuity amount, the fixed amount or the uniform amount which a person gets or a person gives. Again, this 6% is the interest rate. Normally, it is represented by the letter R, that will be in percentage. And then N, the number of years. And here it is 5 year, but he has opened for monthly installment, because recurring deposit is a monthly installment. So 5 year means you have to convert the number of installment. How many years? How many installments? 5 year means 1 year, 12 installments. So 5 year, 5 into 12, 60. So N takes the value 60. So in the case of an annuity, these are the three variables we come across. One is A, the annuity amount. Next is R, the rate of interest. And third, the period, that is N, number of period. So the annuity, as I told you, in the case of compound interest, it can be annually, quarterly, half yearly, etc. Annuity also can be annually or half yearly or quarterly or monthly. So recurring deposit is an example for an annuity where the periodicity is monthly. Even it can be quarterly. We have a deposit scheme where if the customer opts for quarterly interest, you can give, isn't it? All the banks is having a scheme. Suppose a customer deposit 1 lakh rupees or 10 lakh rupees and request, he can have 2-3 options. Number one, he can have it accumulated deposit. That means you quarterly compound and the interest along the principal will be given at the end of the period. 5 year means at the end of the 5 year. But some customer, they come and request for making the periodic payment. And the periodic payment can be the customer request monthly means you can have it monthly, or the customer says quarterly, you can have it for quarterly also. There was a query from the participant how the paper in the previous year. You cannot predict it because previous time it was the first time, and the question was more or less liberal in this retail banking. It was easy to score. Most of the candidates passed it, but this is the second time, so we cannot. And another thing is they are making the paper tough year by year. So that's another point to remember. So be prepared. You have to. This is not very easy to. It's not very easy to eat the cake. You have to work hard, toil, and work hard. Then only it's possible. That's what I can vouch. Okay. So as I told you, looking at the annuity periodicity, the value of R and N undergoes a change. If it is monthly, R will be interest by 1200. If it is quarterly, R will be interest by 400. Similarly, n number of years into 4 or 12 into 6, like that, you have to do it. Now there are so this is what this is about annuity. So there are 2 types of annuities. One is end of the period annuity. Next is beginning of the period annuity. Generally, they will be giving a question from our bank scheme, and almost all bank schemes are end of the period annuity. Otherwise, specifically, they will mention, because the difference between end of the period and beginning of the period is the payment or receipt of the amount, uniform amount, can be made at the end of the period is end of the period. It should be made at the beginning, it is beginning of the period. For example, I given an example of the deposit schemes. These are all end of the period annuities. Now coming to the payment of rent. Suppose you have taken a building on rent. When you took a building or a flat on rent, you have to pay the rent of the first month in advance. So that is an example of beginning of the period annuity. Suppose if you took a house or a flat on lease for a period of 11 months, you have to pay the first month rent first. Then only they will allow you to enter. Am I correct? So that's what the payment of rent is an example of beginning of the period annuity. So look at the question, which formula you have to use, depending upon the way in which they have given the question. If they say they wanted a person is making at the end of every quarter, every year, it is end of the period. At the beginning, if he is making, then it is beginning of period annuity. So there are 4 formulas in this this annuity: 2 for end of the period and 2 for beginning of the period. The first one is the future value of an annuity. Future value of an annuity. Look at the case of a recurring deposit. A customer had opened a deposit, and he will be getting, he is remitting every month 1,000 rupees. At the end of 60th month, at the end of 5th year, what is the amount he is going to get? That is called the future value. So you can, there is a formula, and this formula will give you the future value. It is A by R into 1 plus R, the whole raised to n minus 1. This is the formula. A by R into 1 plus R, the whole raised to n minus. I told you what is A, what is R, and what is n. Now, there is another formula, the present value. The present value is A by R into 1 plus R, the whole raised to n minus 1, divided by 1 plus R, the whole raised to n. So these are the 2 formulas you have to by heart for end of the period annuity. Similarly, there are 2 formulas for beginning of the period annuity. The future value is A by R into 1 plus R, the whole raised to n minus 1 into 1 plus R. And the next one, the present value is equal to A by R into 1 plus R, the whole raised to n minus 1 by 1 plus R, the whole raised to n into 1 plus R. So if you are able to remember at least this formula, the other formulas can be easily remembered with some small tip to you have to remember. That is, look at this one and the second one. See, if this is the formula for end of the period future value, for getting the beginning of period future value, you have to multiply it with 1 plus R. Only change this into 1 plus R. So remember, if the same amount, end of the period and beginning of the period, rate of interest, annuity amount and interest rate same, which will be more future value? Beginning of the period of future value will be more, because there the interest will be calculated from the beginning. Or you can say that this is multiplied with 1 plus R. This is a number more than 1. So definitely this will be more than the future value of end of the period annuity. So that's a point to remember. Similarly, look at the present value. Present value in this formula, you have to write 1 plus R the whole raised to n in the denominator. Other things remain the same. A by R into 1 plus R the whole raised to n minus 1 divided by 1 plus R the whole raised to n. Similarly, to get the present value, you multiply this with 1 plus R. So if you remember the first one, the other three can be easily remembered with some small point to keep in mind. You have to keep in mind some small point. Now there is, see, from this formula, you can calculate. Sometimes the question, instead of present value or future value, they will ask the value of A. So from this formula, you can calculate. So if future value is given, how to get the value of A? The value of A is you cross multiply. When you cross multiply, it is future value into R divided by 1 plus R, the whole raised to n minus 1. Similarly, in the second equation, if you want the value of A and you are given the future value, this is equal to the future value into R, future value into R, divided by 1 plus R, the whole raised to n minus 1 into 1 plus R. So this, similarly, if present value is given, then also you can use the second formula and calculate the value of A. Let me, I have given it here. Look, from this formula, if you want A, if future value is given, it is future value into R divided by 1 plus R, the whole raised to minus 1. If present value is given, then the value of A is equal to present value into R into 1 plus R, the whole raised divided by 1 plus R, the whole raised to minus 1. Similarly, beginning of the period annuity, these are the two formulas. Or you can alternatively calculate the value of A also, annuity amount. We'll move on to another important aspect. One second. Yes, let me explain the EMI, then the other one I'll explain. See, EMI, again, sometimes they can ask a question on EMI. EMI, the formula is equated monthly installment, loan amount into R, P into R into 1 plus R, the whole raised to n by 1 plus R, the whole raised to n minus 1. EMI is equal to P into R into 1 plus R, the whole raised to n divided by 1 plus R, the whole raised to n minus 1. Remember, P stands for the loan amount, R the rate of interest, and N the number of years. So this is a formula for EMI. This formula generally, there can be a question to calculate the value of EMI. Let me clear this. Okay. P into R into 1 plus R, the whole raised to n divided by 1 plus R, the whole raised to n minus 1. And the same formula can be used. even for annual installment or half-year installment or even quarterly installment also. The only difference is if it is annual, rate by 100, n into 1. And if it is half-year, rate will be, R will be rate by 200 and n will be number of years into 2. Quarter means rate by 400 and n into 4. Monthly means rate by 1200 and n number of years into 12. These are the important points to remember. Next is the rule of 72. There are 3 rules. One is the rule of 72. Rule of 72. This is rule of 72. Rule of 72 gives you approximate number of years or approximate rate of interest so that an amount becomes double if the interest is annually compounding. So rule of 72 gives you an approximate number of years or rate of interest. For example, suppose you want the rate of interest and you have given the number of years so that an amount becomes double. What you have to do, you divide the number of years with 72. You divide 72 with the number of years. Similarly, if you want the number of years, you have given the rate of interest. Divide 72 with the rate of interest. You will get the number of years. So rule of 72 is a rule that gives you an approximate number of years or approximate rate of interest so that an amount becomes double. For example, the question, an amount becomes double in 9 years. Interest is compound interest. What is the rate of interest? The question will be like this. An amount becomes double in 9 years. What is the rate of interest if the interest is paid annually compounding? What do you have to do? You have to divide 72 with 9. You will get 8. So the rate of interest is 8%. Or there can be another question. An amount becomes double at, say, 6%. An amount at 6% double in how many years? So you have to calculate number of years. What do you have to do? 72 by 6. That means 12. So this is the rule of 72. Similarly, there are 2 more rules. One is rule of 114. Next is rule of 144. Rule of 114 is for tripling an amount, where this is for doubling an amount. Rule of 114 is for tripling an amount, and rule of 144 is for quadrupling an amount 4 times. Okay, so that means the question can be, an amount becomes triple in 10 years. What is the interest rate? An amount becomes triple in 10 years. What is the rate of interest? What do you have to do? Rate of interest is equal to 114 by 10. That is equal to 11.4%. Similarly, you can calculate the number of years also. Again, another question can be, an amount becomes 4 times in 12 years. What is the rate of interest? So an amount becomes 4 times in 12 years. What is the rate of interest? So 4 times means to get the rate of interest, divide 144 with number of years or with rate of whatever it may be. So here an amount becomes double in 12 years. Rate of interest is 144 by 12. That is 12%. So these are all the 3 rules. So it's here, the 3 rules. One is double, rule of 72, rule of 114, that is triple, and the rule of 144, quadruple. It's a very simple point to remember, because there can be a question, at least for rule of 72. The others also will be of useful for you. This is over. Now we'll move on to some numericals. A person is investing 2,000 every year for next 4 years. Next 4 years, how much money he gets after 4 years? So a person is investing 2,000 rupees every year for next 4 years at 10%. How much money he gets after 4 years? This is the question. So you have to use whether it is simple interest or compound interest or annuity. Look at the question, read it once again. See, an annuity means it is a uniform payment. There will be more than one payment. That means every year, every month, or yearly, or quarterly, half yearly. If such a word is there, it's a question on, it's not a one time, it's a question on, it's a periodical payment, it's a question on annuity. So here, this is a question on annuity. A person is investing 2,000 every year for next 4 years. So this 2,000 is the fixed amount or the uniform amount, and the annuity periodicity is yearly. So N is 4 and is getting an interest rate 10%. How much money A gets after 4 years? So what is to be calculated? How much money A gets after 4 years? So first year is depositing. Then next after 1 year he is depositing again 2,000. Like that, 4 years is depositing 2,000, 2,000 like that. At the end of 4th year, what is the money he is going to get? That means the principal plus interest. That means you have to calculate the future value of an annuity. So this is an because it's a bank scheme, it is under the period annuity. So future value, the formula is A by R into 1 plus R the whole raised to n minus 1. This is equal to A is 2,000 divided by R 10%. 10% means 10 by 100, that is 0.1 into 1.1 raised to 4 minus 1. This you simplify. Simplification part I'm leaving because it takes a lot of time. You can do it. I'll be sharing the PPT. The answer is 9282. 9282 because 1.1 raised to 4 minus 1. 1.1 raised to 4, how to get 1.1 multiply 4 times. 1.1 into 1.1 into like that 4 times. You will get 1.1 raised to 4 minus 1. Then multiply with 2,000 by 0.1, you will get 928. We'll move on to the next question. A person would like to receive 10,000 rupees every month starting from now for the next 5 years. What is the amount he should deposit now if the interest rate for the deposit is 12% at quarterly rest? See, a person would like to receive 10,000 rupees at the end of this month, starting from now. So he wanted to get 10,000 rupees for the next 5 years, monthly. What is the amount he should deposit now if the interest rate for the deposit is 12% at quarterly rest? So he wanted every quarter. He wanted every quarter, isn't it? He wanted every quarter 10,000 rupees. Second, let me take this in a second. Yes. A person would like to receive 10,000 rupees at the end of every quarter starting from now. So what is to be found out? And what are the things given? He would like to get 10,000 rupees. That means that is the fixed amount. A is given 10,000. Then next 5 years, number of years, N is 5 years. The rate of interest, 12%. Now the periodicity of the annuity, it is say quarterly. That means this annuity is quarterly. When annuity is quarterly, 5 year means how many quarters? 5 into 4, 20. So N takes the value 20. And rate of interest is 12%. So R means you have to 12 by 400. Isn't it? Because quarter means you have to divide with 400. And 12 by 400 is 0.03. So R takes the value 0.03, N takes the value 20, and A is 10,000. What you have to calculate? What is the amount he should deposit now? That means we want the present value of this annuity. Isn't it? Because he has to deposit an amount, that is the present value. So that amount he deposit now, he start receiving 10,000 every quarter. So present value of the end of the period annuity, what's the formula? Present value is equal to A by R into 1 plus R, the whole raised to N, minus 1 by 1 plus R, the whole raised to N. This is the formula. You calculate. The present value is equal to, this is the formula. Substitute the value of A, R, and N. Here the solution. A by R into 1 plus R the whole raised to N minus divided by 1 plus R the whole raised to N. That means 10,000 by 0.03 into 1.03 raised to 20 minus 1 divided by 1.03 raised to 20. On simplification, you will get 1,48,774. That means if this person invests 1,48,774 and if the bank is paying him 12% at quarterly rest, he gets 10,000 rupees every quarter. After end of first quarter, he get 10,000. Like that, next 5 years, he get 10,000, 10,000. And end of fifth year, it's over. He is not getting any more principal or nothing. The interest along with the principal has been received by this person. That is the case of an annuity. Okay, we'll move on to the next one. Find the EMI of a vehicle loan for rupees 6 lakh at 12% repayable in 7 years. Again, as a straight question, EMI. So you should use the formula for EMI. What's the formula for EMI? EMI is equal to loan amount into rate of interest into 1 plus R the whole raised to N divided by 1 plus R the whole raised to N minus R. This is the formula. Now you calculate, you find the values. Loan amount is P, 6 lakh. Rate of interest R is 12%. Now 12% you have to, since it is EMI, equated monthly installment, 12 by 1200. 12 by 1200 is 0.01 and N 7 years. 7 years means 7 into 12. That means 84. Now you substitute the values. P is 6 lakh into 1.01 raised to 84 divided by 1.01 raised to 84 minus 1. This we have to find out, simplify and find out. How to get 1.01 raised to 84? Whether all of you are familiar? Why do we divide? Why do we divide with 1200? That's what you have joined now only. See, the beginning I told you, look at whether it is compound interest or annuity. Look at the periodicity of the annuity. If it is annually, divide the rate of interest with 100. If it is annually, the periodicity compounding interest or annuity is periodicity is annually, rate of interest by divide by 100. 8% means 8 by 100, 0.08. 10% means 10 by 100, 0.1. Now, if it is half yearly, the rate of interest divided by 200. If it is quarterly, the rate of interest by 400. If it is monthly, the rate of interest by 200. It's a very simple thing. You have learned in your schooling. When the compounding interest is monthly, you have to divide the rate of interest with 1200 and years you multiply with 12 because 1 year means 12 months. Okay. So this you simplify. Here it is here it is 10,592. EMI is 10,592. I'll go to the next question. Simplification part, you don't bother because I'll be sharing it. A person requires 10 lakh rupees at the end of 5 years for admission of his daughter to a professional college. So a person wanted 10 lakh at the end of 5 years. How much he should save monthly from now if the interest rate he gets on the deposit at compound interest rate 6%. So compound interest 6% is getting. Here it is a person would like to get 10 lakh at the end of 5 years for admission of his daughter to a professional college. How much he should save monthly? That means every month he has to save. And what is the amount he has to save every month? That means this is a question of annuity. You have to calculate A. So this is the periodicity of the annuity is monthly. Periodicity of the annuity is monthly. We want A. And what is given? 10 lakh. What is this 10 lakh? Is it the present value or the future value? A person requires 10 lakh at the end of 5 years. So this 10 lakh is the future value. So you have given the future value and you have given the number of years. This 5 means since it is monthly annuity, 5 into 12. That means N is 60. Rate is 6%. Since it is monthly, 6 by 1200. 1200 is 0.005, isn't it? 6 by 1200, 0.005. So you substitute. Future value is known, N is given, R is given. We want A. So A is equal to, the formula is future value into R divided by 1 plus R, the whole raised to n minus 1. This is the formula. So here it is. Future value into R divided by 1 plus R, the whole raised to n minus 1. That is 10 lakh into 0.005 divided by 1.005 raised to 60 minus 1. This on simplification, you will get 14,335. That means every month, if we can save 14,335 for a period of 5 years, at the end of 5th year, the principal along with interest comes to rupees 10 lakh. Next, such questions also can be asked. What is the effective annualized interest rate if bank is charging interest at 3% per month on credit card dues? So we are going to discuss about credit card in the next session, but still here the credit card interest bank is charging 3% per month. So if 3% per month is the interest rate, what is the annual interest? 3% per month means annual interest, it is 36%. So here the effective annualized interest. Annualized interest means you have to compound it. See, credit card, it is monthly compounded. So here the effective interest or annualized interest, the formula is 1 plus R, the whole raised to n minus 1 into 100. This is the formula, 1 plus R, the whole raised to n minus 1 into 100. This is the formula. So this formula you have to remember. Now look, you have given, you have to do it for 1 year. So when annualized interest, a question is coming for annualized interest, you have to take the number of years as 1. Okay, so number of years is 1, but here this is monthly. So this means n takes a value 1 into 12, that means 12. And rate of interest, it is monthly 3% means 3 by 100, that means 0.03. You substitute here. So effective interest is equal to 1.03 raised to 12 minus 1 into 100. This is equal to 1.03 raised to 12, 1.03 into 1.03 into 12 times, minus 1 into 100. That you will get it as 42.58%. So 3% per month means 36% per annum, and 36% per annum means it is monthly compounding, because credit card dues, it is monthly compounding. Every month they add the interest to the principal and calculate interest on the interest also. That is what. So the effective interest is 42.58%. Okay, we'll move on to the next one. Kavita took a housing loan for rupees 25 lakh, which is repayable in 20 years in half-yearly installment at 7.5% interest at half-yearly rest. Find the equated half-yearly installment. Such questions also they can ask. You can use, see, the EMI formula can be used for equated annual installment or equated half-yearly installment or equated quarterly installment. The same formula can be used. Only thing is, if it is annual, you have to rewrite R and N accordingly. Similarly, half year also and quarterly also, you have to rewrite R and N. Quarter means rate divided by 400, N into 4. Half year means rate divided by 200, N into 2. Annual means rate divided by 100, N, you can take same. So here the housing loan amount is 25 lakh. So in the formula, you can write P is equal to 25 lakh. And number of years, N is equal to 20 years. But remember, 20 years, it is half-yearly installment. So 20 means 20 into 2 means 40 half years. And R is 7.5%. 7.5% half-yearly rest means 7.5 by 200. That is equal to 7.5 by 200. You will get 0.0375. 0.0375. Now you substitute. So we want equated half-yearly installment. So equated half-yearly installment is equal to, the formula is P into R into 1 plus R the whole raised to n divided by 1 plus R the whole raised to n minus 1. P is 25 lakh into R 0.0375, 0.0375 into 1.0375 raised to 40 divided by 1.0375 raised to 40 minus 1. This you simplify. Here it is. 25 lakh into 0.0375 into 1.0375 raised to 40 divided by 1.0375 raised to 40 minus 1. On simplification, you will get 1,21,649. So that means every half year, he has to pay 1,21,649 for the 25 lakh rupees housing loan. Clear? We'll move on to the next one on housing loan. X availed a housing loan of 20 lakh at 7.5% repayable in 240 equated monthly installment. Compute what is the EMI of the housing loan, what is the total interest to be paid, what is the balance amount in the loan account after 5 years. If the bank had increased the interest rate to 8% after 5 years, compute the revised EMI. So these are all the 4 questions. Can be a question with some 5 marks or 4 marks. Such case study also they used to ask. See here, you are given the loan amount is 20 lakh. Means in the formula, P is 20 lakh. Rate of interest R is 7.5%. 7.5% means it takes 7.5 by 1200. 7.5 by 1200 is, right? 7.5 by 1200. 0.00625. This is 0.00625. Next, N. It is given 240. So the first question is, what is the EMI of the housing loan? Straight away use the formula. I'm not spending much time on that. Here look, EMI is equal to P into R into 1 plus R the whole division by 1 plus R the whole division minus 1. 20 lakh into this amount. On simplification, you will get 16,112. So the first question, the EMI is 16,112. 16,112. Now, the next question is, what is the total interest to be paid by Mr. X in this housing loan? That means he had taken a loan of 20 lakhs and he started promptly, he is paying every month 16,112 for a period of 240 months. Now the question is, what is the total interest he had paid? How to get that? The total amount repaid, total amount repaid is equal to, how to calculate? It is every month he is paying 16,112. So 16,112 into 240. You calculate 16,112 into 240. This is the total amount he has paid to the bank. 38 lakh, 66,880. So this is the total amount remitted. So can you tell me what is the interest portion? Because he had taken 20 lakhs loan. So interest portion means you have to subtract 20 from this. It is 18 lakh, 66,880. So the second question is 18 lakh, 66,880. Clear? No doubt? Now we'll move on to the third question. What is the balance amount? What is the balance amount in the loan account to be paid by Mr. X after 5 years? This is a tricky question. Little bit difficult to calculate. Here, remember, he has started repaying the loan. He has started repaying the loan with every month 16,112. So like that, he repaid for a period of 5 years. That means he had repaid 60 installment of 16,112. Now, what is the balance amount in the loan account? How to get that? See here, to calculate that amount, you have to immediately, you have to take to your mind, bring to your mind a loan ledger. How a housing loan ledger will reflect. See, suppose in a month of, say in the month of January, you have granted a loan. Suppose you have granted 25 lakh rupees loan. And then a housing loan, all retail loan, it is monthly compounding. So every month we calculate the interest. So at the end of first month, that means on 31st January, you calculate interest. So there will be debit, credit, balance. So you debit, suppose you debit 20,000 rupees. So this 20,000 will be added. Am I correct? So the amount becomes 25 lakh plus 20,000. Now, in the month of January, he has repaid 25,000. So there is a credit of 25,000. There is a debit of 20,000. And so the balance will be, so 20 debit, 25 credit. So 5,000 credit more will be there. Therefore, it becomes 24 lakh 95,000 will be the outstanding. Again, in the month of February, we charge interest. We charge debit, say 19,500. Again, the customer is paying 25,000. So this 19,500 will be debited and 25,000 will be credited. Like that, it continues for a period of 5 years. So at the end of 5 years, what should be the amount? So like that, if you rewrite the ledger, it's a very lengthy procedure. It takes nearly 4 or 5 hours. Now the question is for a 1 minute or 2 minute question. So you cannot do that exercise. So what the way out is, what we are going to do is, here the loan amount is 20 lakh. So at the end of 5 years, what is the amount? 20 lakhs plus its interest. You calculate. The amount due from the customer, you calculate separately. Now he is remitting 16,112 for a period of 60 months. So this you can take as an annuity. 16,112 is an annuity amount, or you can take it as a recurring deposit, which he is giving to the bank. So see, he has taken a loan of 20 lakh. Bank will charge interest for that. And he is repaying 16,112 every month. And for that, you have to pay interest to the customer, both at the same interest. So what we do is, loan of 20 lakh, we calculate with interest separately. And the repayment, we along with interest, we calculate separately and minus it. That will be the loan ledger balance. So here, calculating the interest for this 20 lakh is very simple. You have to use the compound interest formula. Compound interest formula, A is equal to P into 1 plus R, the whole raised to n. You can use this formula. P is 20 lakh into 7.5% monthly. So 7.5 by 1200, we have calculated 0.00625. So 1.00625 raised to 5 years means 60. This you calculate. This will be the principal along with interest at the end of 5th year. That is the total amount due from the customer. Now the customer is paying 16,112. This you can take as an annuity, where 16,112 is A, R is 7.5%, that means 0.00625, and N is 60. So use the formula for end of the period annuity for getting the future value. Future value is A by R into 1 plus R, the whole raised to N minus. Use that formula, calculate the future value of the annuity and subtract. So future value of 20 lakhs after 60 months, we have calculated 29 lakhs 6,600. Then the repayment here made, it is in the form of an annuity, where A is 16,112, R is 0.00625, and N is 60. That you rework, you will get simplification 11,16,571. So total amount due from the customer, including interest, is 29 lakh, out of which he had repaid 11,68,000. So the balance amount will be 29,06,600 minus 11,68,571. You'll get it as 17,38,029. So this is the amount in the ledger. Now, next question. If the bank had increased the interest rate to 8% after 5 years, so interest rate is increased to 8%. Originally, it was 7.5. Now, after 5 years, it is 8%. What is the revised EMI? So what you have to do at the end of 5th year, the loan amount from the customer, it is 17,38,029. This is the amount at the end of 1st year. Now, sorry, at the end of 5th year. Now the interest rate is 8%. 8% means 8 by 1200. 8 by 1200 is 0.00667. So 8 by 1200, 0.00667. And the N, originally 240 installment, but 5 year over, already paid 5 year. So N is remaining period on 80. Use the formula for EMI with the loan amount as 1738.29, rate of interest at 0.00667, and the number of installment on 80. You will get the EMI of 16,650. That's all with respect to interest calculation. These two are there. You can easily do it. I'm just leaving it. One more question is there. A government security with a par value of 1 lakh due for payment 3 months from now is trading in the secondary market at 97,087. What is the effective annual yield? What is the effective annual yield? See, government security 1 lakh due for payment 3 months from now. Here, see, government securities and all, it is simple interest. You have to calculate R. R is equal to the formula for simple interest. I is equal to PNR, or R is equal to I into 100 by P into N. This is the formula you have to use. Here, what is P? Secondary market, it is trading at 97, means if you buy the security, you have to pay 97,087. You have to wait for 3 months, and then you will get 1 lakh. So what is the return is getting? It is 1 lakh minus 97,087. This is the income he is getting. So this is I. And N is 3 months. So use the formula. Here it is. I into 100 by P into N, where I is 2,913. N is 3. 3 means 3 by 12 or 0.25. So you will get rate of interest as 2913 into 100 by 97087 into 0.25. That means effective interest is 12%. We will finish this depreciation and I will give you a break. I'll take only few minutes on this. Is it okay? Maximum? 10 minutes, then I will give you a break. Depreciation. See, there are two types of depreciation for as far as your exam is concerned. There are so many other methods. It's not required for you. One is straight line method. Another is written down value method. So these are the two different types of depreciation calculation as far as your paper is concerned. In straight line method, it is calculated every year on the original cost. So there is no change in the depreciation amount. I'll give an example. Suppose the cost of a machinery is 1 lakh. And in straight line method, either they can give you the depreciation rate or they will give you the useful life. Or I can say in straight line method, the depreciation per year is equal to original cost minus scrap value by useful life. This formula you have to by heart. Depreciation is equal to original cost minus scrap value divided by the useful life. You might have studied it and learned it in the other paper, accountancy and all. Even though I'll explain it. So suppose the original cost is 1 lakh. And let us assume that the scrap value is 0. And useful life is a 5 year. So what is the depreciation under straight line method? It is 1 lakh minus scrap value 0 by 5. That means you will get 20,000. This is the method. That means first year depreciation 20,000, second year also 20, third year 20, fourth year 20, fifth year 20. At the end of fifth year, the value of the asset becomes 0. Because we are diminishing, we are deducting every year 20,000 on the cost. This is what in a straight line method. In the case of written down value method, here 2 points remember. Number one, here the scrap value is not considered. So in written down value method, even though the question they give you the scrap value, don't take into account. Scrap value, we are not taking into account for computing depreciation under written down value method. But we need the rate of depreciation. Suppose the rate of depreciation, the same question, suppose the cost is 1 lakh and rate of depreciation is 10%. In written down value method, how you calculate the depreciation per year? For calculating first year depreciation, you calculate 10% of 1 lakh. 10% of 1 lakh is coming to 10,000 rupees. Now, second year, what you have to do? The cost is 1 lakh. So 10,000 we have accounted towards depreciation. This 10,000 has to be deducted. So the cost becomes 90,000. So remember, at the end of first year, the cost of asset becomes 90,000. So for second year, you have to calculate depreciation 10% on 90,000. That is coming to 9,000. So next it becomes 81,000. So third year, the depreciation is calculated on 81,000. That means 10% of that is 8,100, and it goes like that. So remember, in the case of straight line method, the depreciation amount remains the same throughout. If it is 20,000 first year, second year, third year, every year it is 20,000. But in the case of written down, it diminishes. That's what we also call it diminishing method of depreciation. Okay, so in written down, there is a formula. The formula is for depreciation, the formula is A is equal to the book value is equal to the original cost into 1 minus R raised to. So this formula is similar to the compound interest formula. In the case of compound interest formula, it is P into 1 plus R, because there the interest is added every year or every compounding interest. Here, the depreciation amount is deducted every year. That's what the formula with a small modification. If it is P into 1 minus R the whole raised to n, you can use this formula to calculate the book value under written down value method or diminishing value method. So remember, A is the book value. Don't get confused between the depreciation and book value. Depreciation is the depreciation amount. Book value means after accounting the depreciation, what is the value of the asset in the books. that is called book value. It's an example. Well, this is I have explained all these things. Up and down value. Then this is a comparison. You can we'll do 1 or 2 questions on this, and I'll give you a break. On for 2016, a machinery was purchased for 1 lakh and spent 20,000 for transportation and 10,000 for its installation. If the firm computes the depreciation at 10% on written down value method, compute the depreciation up to 31/3/2020. See, one point to remember is the original cost here. It is the cost is 1 lakh. But for calculation of depreciation, you can add the transportation cost, also the installation cost. Everything will be added. So the cost of the machinery can be taken as 1,30,000, not 1 lakh. So remember, when an asset is acquired at the before, no, it has to be transport. Suppose the firm is buying it from Delhi. His factory is in Chennai, so he has to get it transported to Chennai. So the transportation expense he has to bear, that he can add to the cost. Similarly, for installation purpose, he requires some amount for addition, making a shed or platform, whatever it may be. So that additional installation charge also can be added to the cost. So total cost of the machinery is 130. And depreciation, it is calculated at 10% on written down value method. So what is the depreciation up to 31/3? So 1/4/2016 he has purchased. So 1/4/2016. So 31/3/2017 first year, 31/3/2018, 31/3/2019, and 31/3/2020. So how many years? 4 years. So you have to calculate the depreciation up to 31/3 means this 4-year depreciation. You can use the formula A is equal to P into 1 minus R the whole raised to n. P is 130 into 1 minus rate of depreciation 10%. 0.1. N is 4. This is equal to 130 into 0.9 raised to 4. That is equal to 130 into 0.9, 0.9 into 0.9 into 4, 0.6561. 6561. So this into 130. 85,293. This is the book value as on 31/3/2020. So original cost is 130. Now the book value is 85,293. What is the depreciation? You have to subtract 85,293 from 130. So I sold it here. 85,293 you are getting as the book value. So the depreciation amount is 130 minus 85,293, 44,707. This is the way in which we have calculated depreciation using the formula. Instead, you can using this table. See, at the end of first year, 1,30,000 is the value. 10% is coming to 13,000 amount of depreciation. So this is the book value. You subtract 13,000 from 130. Then for the second year, this 117 is the book value. 10% on that, 11,700. Subtract 1,05,300. Again, 1,05,300, 10%, 10,530. Fourth year, 94,770, 10% is coming to 9,477. So this will be in that way also you can do, but this way it takes more time. By applying the formula, you will get in 1 minute. Here, you may take 4 or 5 minutes to get the answer. So whichever is better or fast, you can use that method. There is another question. A machinery was purchased for 1 lakh, spent 20,000 on its overhauling. Depreciation is computed 10% on original costs. On 10th June, the machinery was sold for 75,000. What is the loss or profit account on this? So look, the original cost is 1 lakh plus 20,000. That means 120. This is purchased on 2017. Depreciation is calculated at 10% on original cost. What is the method? If the depreciation is calculated at 10% on original cost means it is straight line method. 10% on book value means it is written down value method. So it is 10% on original cost. That means every year 10% on original cost is calculated. Now they have sold it on 36/2020. So how many years over? One for 2017 they purchased, 2018 1 year, 2019 second year, 2020 third year. So 31/3/2020 it is 3 years, and for 36/2020 another 3 months. So 3 year, what is the depreciation? 10% of 120. So for 3 year depreciation is 36,000. And for 3 months, what is the depreciation? For 1 year, it is 12,000. So for 3 months, it is 3,000. So total depreciation is 39,000. 120 is the book value. 39,000 you have provided depreciation. What is the book value as on 36? 120 minus 39, that is 81,000. So in the company's book, the asset is costing 81,000. At what price they have sold? They sold it for 75,000. So what is the profit or loss on this sale? As per the book, it is 81,000. They sold it for 75. So they incurred a loss of 6,000 rupees. Here it is. This is another question. I think a solution is there. I can leave it because of the time constraint. I'll look at 1 or 2 questions. The book value of a machinery after 3 years of its use is 51,200. What is the original cost of the machinery if the firm compute depreciation under written down value method at 20%? Here you have given the book value. Book value is 51,200. And you have to calculate the original cost. Method is written down value method, and rate of depreciation is 20%. So you go to the formula. In written down value method, the book value A is equal to original cost into 1 minus R the whole raised to. We want the original cost. So P is equal to A by 1 minus R the whole raised to. What is A? The book value. Book value is 51,200 by 1 minus R is equal to 20%. 20% means 0.2. And this is after 3 years. So N is 3. This is equal to 15,200 by 0.8 cube. 15,200 by 0.8 cube. 0.8 into 0.8 into 0.8. 0.512. So you'll get the answer as 1 lakh. Yes. There's 2 more questions. With this, I'll give you a break. Cost of a car is 5 lakh and rate of depreciation is 10% on written down value. The salvage value of the car is 1 lakh. What is the book value of the car after 3 years? Cost is 5 lakh. So original cost is 5 lakh. Rate of depreciation R is 10%. Method is written down value. Salvage value is 1 lakh. Look, if the method of depreciation is written down value, don't take into account the salvage value. We are not concerned about the salvage value. We look at the cost only. What is the book value after 3 years? That means we want A. A is equal to, the formula is P into 1 minus R the whole raised to. P is 5 lakh. That is the original cost. Into 1 minus R is 10%. 0.1 raised to 3. That is equal to 5 lakh into 0.9 the whole cube. 0.9 0.9 into 0.9 into 0.9, 0.729. So this is equal to 5 lakh into 0.729. This you calculate 3,64,500. 3,64,500. This is the value of the asset after 3 years. Next question. Rate of depreciation is 8%. So R is 8%. And cost of an asset is 1 lakh. Original cost is 1 lakh. What is the value of the asset in the beginning of 5th year under written down value method? Similar question, but there's a small twist. What is the value of the asset in the beginning of 5th year means what is the value of N, whether it is 5 or anything else. Beginning of 5th year means end of 4th year. And end of 4th year, it is N is equal to 4. Exactly, yes. N is equal to 4. So use the same formula. Same formula you can use. P 1 lakh into 1 minus 8%, 0.08 raised to 4. Here it is. 1 lakh into 1 minus 0.08 raised to 4. We'll get it as 71,639. I'll give you a break. Now we'll start at 9 o'clock. Is it fine? It's 8:45. Isn't it? It's 8:45. Shall we start at 9? Is it fine? Okay. Hello?
Okay, sir.
Okay. Okay. Come and join at 9 o'clock. Two questions. Tell me. Naveen? It is there in the chat.
Sir, can I have a second question once again, sir? I'll take the screenshot.
Second question. Okay. One second.
Sir, break ആണോ?
Break ആണ്. They want some clarification. 9 o'clock reassemble. We'll reassemble.
Okay.
Can you see the question?
Second one, sir.
This one.
Yeah.
Okay. See, on for 2015, a firm purchased.
Okay. Okay. I took a screenshot. I got it.
Okay.
Thank you.
Okay, join at 9 o'clock. Yes, welcome back. Yes, friends. Shall we start? These are the topics we would like to cover in this session. First is reverse mortgage, then credit card dues, capital gain tax, retail loans, income from house property, and floor space index. We'll wait for a few minutes, 1 or 2 minutes. In the meantime, if you have any point to be clarified in the previous session, please, you can ask it now. Either in the chat box or you can talk, unmute and talk to me. You can presume that you don't have any doubt. Am I audible? Can you hear me?
Yes, sir.
Okay.
Yes, sir.
Okay. Let us begin. We'll move on to reverse mortgage. All of you are familiar with the mortgage law, isn't it? In a mortgage, we give various types of mortgage loans, say housing loan or a business loan. All this vehicle loan, all this loan we under mortgage we give. We take a security and we give it, isn't it? So in that case, you take a security and you release a loan in lump sum, and the borrower has to pay it in installment. That is a mortgage loan, whether it is a business loan or a housing loan or a term loan. It happens like that. You give in, say, 5 lakh rupees or 10 lakh rupees, 25 lakh rupees you are giving to the customer, and the customer has to repay it in installment. In reverse mortgage, it is just a reverse. That means you release installment to the customer. The loan will be disbursed in installment. And towards the end, they have to repay it. Who? The borrower need not repay. That is the peculiarity of reverse mortgage loan. Then what? For whom? Who is eligible? And what's the purpose of reverse mortgage loan? This is of recent origin, means not very recent. National Housing Bank, they have formulated, in consultation with the Reserve Bank of India, they have formulated a scheme called the reverse mortgage. And this is meant for the senior citizens. Because, nowadays, say the senior citizen, the old age people, they are finding it difficult to live in, to meet their medical expense or living expense, and they don't have any other supporting income. But they have a house, they have a landed property, a big house, or they have a house. Then how to live? So in order to take care of this issue, the NHB has formulated a scheme, and this has been circulated among the banks. And now almost all banks are granting this loan. So what are the eligibility? The purpose is to supplement the income from regular expense, medical emergencies, renovation. It's not eligible for business or trading, speculation, or gambling. So a senior citizen means age who has completed 60 years, 60 plus. So only those people who can go for a reverse mortgage loan, and the purpose should be for meeting their livelihood or meeting their medical expense or renovation of their house. It cannot be used for any trading activity, speculation, or business activity. Borrower not required to service the loan during the lifetime. That's another peculiarity. The borrower means to whom you are granting this loan, because they don't have any income. They are seniors, they cannot work. If had they able to work, then they need not come to you for taking a loan. Am I correct? So this loan, the borrower need not repay during his lifetime. That's another thing. He need not pay the principal nor interest. And in the case of joint owners, suppose the house is in single name, and if he's a senior citizen, you can grant. If it is in the joint name, husband and wife, in such a situation, the one of the spouse should be above 60, another should be above 55. Then only they are eligible in the case of joint owners. It's applicable, the security only for residential purpose. Suppose they are owning a commercial property and that is giving to us loan as security, you cannot grant under reverse mortgage. So reverse mortgage loan can be granted only for residential property, and it should be free from encumbrances. That means, suppose he had taken some other loan against the security of that property, you cannot grant a reverse mortgage loan. So the property should be free from encumbrances, and the life should be, the life of the property, residual life should be minimum 20 years. The loan period is maximum 20 years. Generally, it is 20 years, maximum 20 years. And the loan will be disbursed according to the customer's choice. It can be monthly, it can be quarterly, it can be half yearly, it can be annually, or it can be in lump sum also. And in lump sum, there is, in monthly also, there is a cap. If the maximum 50,000 rupees, if the customer is asking for a monthly disbursement of the loan, you can grant, but maximum is 50,000, because you are granting this loan for their livelihood, to meet their expense, living expense, or urgent medical expense. So now it is capped at 50,000. Next, if the customer is asking for a lump sum payment, either for some operation or for renovation of the house, you can grant, but there is a cap again. Only 50% of the eligible amount you can grant. If he is eligible for 10 lakh, you can grant 5 lakh under lump sum, and the remaining 5 lakh in installment of annually or year, half yearly, quarterly, or monthly. Then, if the borrower is not staying in the house, which he has given to you as security, for a continuous period of 1 year, or if he is not paying the local tax for a period of 1 year, you can foreclose the loan. So that's another thing. A person has granted a loan, availed a loan under reverse mortgage, he has shifted his residence to some other place, you can foreclose. Again, suppose he is not remitting the tax, the municipal corporation is not taxable. Whatever amount you are giving, it is not taxable. Then another important point is the borrower and spouse, they can stay back in that building until their death, even after completion of the tenure of the loan. That means at the age of 65, you are granted a loan, reverse mortgage loan, for a period of 20 years. You start going on releasing. So at the 20th year, loan will be, total amount will be disbursed. Now he is not eligible for any further installment, but he is 85 years, still alive, or his spouse is alive. You can allow them to stay back until their death. This is another feature of this scheme. So these are the important points to remember. Now, there is a formula for finding out the installment. The formula is V into LTV into R divided by 1 plus R the whole raised to n minus. Where what is V? The value of the property, LTV, loan to value, R, the interest rate, and the number of installment. Now we'll discuss a case. There is a person who is a senior citizen. Please, sound is coming. Please mute.
ABCD.
Please mute your mic.
You are in mute, sir.
Okay. Mr. Thomas, a senior citizen, is owning a house worth 100 lakhs. He approached his bank to avail a loan under reverse mortgage loan scheme to meet his daily medical and living expenditure. As per the loan scheme, bank sanctioned a maximum of 80% of the value of the security at 9% repayable in 15 years. Based on the above data, answer the following. So this particular bank, NSB or Reserve Bank of India has issued the broad guidelines, and individual bank can formulate their own scheme. So this particular bank, they sanction maximum 80%. If the value of the security is 100 lakh, they give 80 lakh. That is the LTV, the maximum amount, 80% of the value of the security they give. And they charge interest 9%, repayable in 15 years. So this is their scheme. Now the question is, what is the monthly installment Thomas will get under reverse mortgage loan? So here you have to use the formula. Reverse mortgage EMI, the other EMI is not applicable. That formula is not here. Here it is the V into LTV into R divided by 1 plus R, the whole raised to n minus 1. This is the formula. Okay. V into LTV into R divided by 1 plus R, the whole raised to n minus 1. This is the formula. Now, what is V? The value of the property. Value of the property is 100 lakh. So V is 100 lakh. And LTV, it is 80%. 80% means 0.8. And R is 9%. 9%, it is monthly. So 9 means 9 by 1200. And 9 by 1200 is, I told you, if it is monthly, you have to divide with 1200. 0.0075. Now use this formula. V is 100 lakh into LTV 0.8 into R 0.0075 divided by 1.0075 raised to 15 year. 15 year means how many months? 15 into 12, 180 minus 1. Now, naturally, some of you may have a doubt how to find this 1.0075 raised to 180. You can use Casio calculator MJ120D, the 12-digit calculator that can be used. And to get the answer of this, straight away 180th power may not be possible. So what I recommend you take 1.0075, you factorize this 180, say into 10, the whole raised to 80. Like that you can take. Because in any fashion, either 12 into 15, something like that, 20 into 9, any way you can take it. So I have used first 10 to the power, then 18, because 180 is 10 into 80. So how to get this 1.0075 raised to 10? For that, take the calculator. Take the calculator. Type 1.0075. Then put into. Then again 1.0075. Then take the equal sign. Now you keep on tapping the equal sign alone until you get 11 on the left hand top corner. You are getting it as 1.07758. Now this you have to take 80 in the power. So again, clear it, 1.07758 into 1.07758. Now keep on tapping the equal sign until you get 19 on the top. Means 3.8378. How much I am getting? 3.8380. You are getting, I have taken, so finally the answer will be 3.83 80. I have taken one more decimal like that. It hardly matters. Small variation will be there. So look here. It is 10 lakh into 0.8 into 0.0075 divided by 1.007 raised to 180 minus 1. On simplification, you will get 21,142. So he is eligible for a monthly installment of 21,142. What does this mean? This means that when you sanction this loan, every month you will release 21,142 to the customer. And at the end of first month, you add interest. Again, second month, again you release another 21,142. You calculate interest. Like that, you continue it for 15 years. At the end of 15th year, the total book outstanding in your loan ledger will be how much? It will be 80 lakh. That is the meaning. Got it? What is there in the chat? 1 second. IBS book, which page? I don't know. That this IBS material, I not seen it. This is the questions from the previous year's pattern. I have framed all these questions. That's all. And I'll be sharing the PPT after the class. So that is the meaning of this 21,000 EMI 21,142 refers to every month the bank will be crediting customer's account with 21,142 SB account on 21,142 by debiting the loan account. Second month also you debit the loan account and you charge interest every month. And at the end of the 15th year or 180th installment, when you release the 180th installment, and after that the interest and the principal together will be 80 lakh. That is the concept. Clear? Now, then you may have a doubt. Nobody has raised it. How the bank can recover the money? There are two ways for recovering the money. Number one, after the death of the borrower, you can inform the legal heirs. There is a loan outstanding in the books, in our books. This is the total amount. If you're interested to close it, you can close it. So the legal heirs, the son or daughter, or whoever it may be, they remit the money, they close the loan, you release the property to the legal heir. If nobody is willing to close, willing to remit the money, then you sell this property and the loan will be adjusted. That is the way out. Now, second question, if bank charges interest at 12%, what is the monthly installment Thomas get? Very simple. The same question, the same principle way, the only change is you have to change R from 9% to 12%. So if you change this 9 to 12, this will be 12 by 1200. That means 0.01 and no other change. Look. So 12%, R will be 0.01. Use the formula, you will get 16,113. Now, third, if Thomas would like to get the installment quarterly, what is the quarterly installment? The same thing, instead of monthly, he wanted to have it quarterly, every 3 months. So what's the change? In the case of quarter, 15 year means 15 into 4. That means N is 60. And 9% quarter means 9 by 400. 9 by 400. Because I told you it is quarter point 0.0225. So R will be 0.0225. N will be 60. No other change. You use the formula. So installment quarterly means R is equal to 0.0225, N 60. Use the same formula. You will get 64,283. Next, if Thomas needs the payment annually, what is the annual installment he gets? Again, the same formula can be used. Here, R is equal to 9% means it is 9 by 100. 9 by 100. Annual means 9 by 100. And 15 year, N 15. So 9 by 100, 0.09, N15. Same formula can be used. You will get annual installment 2,72,469. Every year, bank will release 2,72,469 for a period of 15 years. At the end of 15th year, the amount with interest will be around 80 lakh. And the last one, if Thomas needs 25,000 rupees per month, find the value of the property required. So here in this question, 25,000 rupees he require per month. That means what is it? It is EMI. EMI is 25,000. You have to calculate the cost, isn't it? So the same formula you can use. EMI is equal to cost into LTV into R divided by this, or cost is equal to EMI into 1 plus R the whole addition minus 1 divided by LTV into R. So on simplification, you will get 1 crore 18 lakh 25,000. Can I go to the next? That's what with respect to reverse mortgage. Sometimes they may ask a question. Last time they are not asked it. Shall I go to the next? Okay. Next is credit card. Every time they used to ask some question on this. I think most of you will be having a credit card, and but you were not aware of how the interest is charged on this. There are few points to remember in the case of credit card calculation. Number one, it is the billing cycle. See, if you are holding a card, different bank, the billing cycle will be different. Some bank, the billing cycle is from, say, first is the billing date. So the billing date. Some bank, it is 20th. Some bank, it may be 10th. So the billing date 20th means in this bill, see, credit card, it is every month the bank will be generating the bill. So billing date 20th means all the purchases, suppose it is, say, 20th of, say, September. So 20th September bill will have transaction from 21st August to 20th September. And next, that means all purchases which you have done with the help of using this credit card will be reflecting, all purchases between 21st August to 20th September will be reflecting in this. And similarly, if the billing date is 10th, that means from 11/8 to 10/9 will be there. And next bill will be 10th October. 10th October bill will have transaction from 11/9 to 10/10. Okay, that is one point to remember. Second is all credit card companies or all banks, they give an interest-free period. What is the meaning of interest-free period? Interest-free period means you need not pay interest on that purchase. You would purchase using credit card. The difference between debit and credit is debit card. When you use debit card and make a purchase, immediately your account will be debited. In the case of, that means there should be sufficient balance in your account. In the case of credit card, they are giving it as on credit. You need not have balance in your account. You can go on purchasing up to that limit. And once the limit is reached, then you cannot use it. And you get a time for paying it. And that period is called the interest-free period. And this interest-free period, you are eligible only if you have remitted or you have paid the previous bill in full. If you are not paid in full, you are not eligible for interest-free period. Generally, interest-free period will be 20 days. Most of the bank give 20 days interest-free period. That means if they have generated a bill on 29, this 29 onwards, you get 20 days time for making the payment of the bill. That is the meaning of interest-free period. So if the bill is generated on 20th of September, you get 20 days time from 20th of September. So in September, how many days? Count from 20th. From September 21st, like that, you get 11 days. And then in October, you get 9 days. That means 20 days. That means on 10th of October, you have to pay. The due date is 10th of October. You get 20 days time. So remember, if you pay it either on, so the due date, this is the due date. If you pay it either on due date or any day prior to the due date, you are eligible for interest-free period. But suppose you paid after this, you paid 11/10. You are not eligible for interest-free period. And the bank will charge interest from the day when you have made the purchase. I'll repeat once again. Suppose you have not paid your credit card bill on due date and you paid it after that. You are not eligible for interest-free period and you have to pay interest from the date of purchase, original purchase of that transaction. Not from for on day. Okay, so these are all the important points in credit card. One is bill generation or the billing date, next the due date, next interest-free period. I explained. Not eligible for interest-free period. In what are the cases? Minimum amount was paid. Then also you're not eligible. Payment made is less than the minimum amount. Then also you're not eligible. No amount is paid. Cash withdrawal made. So remember, in the case of cash withdrawal, suppose you have withdrawn cash using your credit card. No interest-free period. From the day onwards, they charge the interest. So remember, cash withdrawal is very costly. Don't withdraw cash using credit card until it is warranted. And very emergency, you have to. Otherwise, don't go for cash withdrawal using credit card. Next, minimum amount due, it is 5% of the amount outstanding. If the total amount outstanding is 50,000, 5% they have to pay. That is the minimum amount. Or 250, whichever is higher. So 250 or 5%, whichever is higher. And if the bill amount is less than 250, actual amount. If the bill amount is 100, you have to pay only 100. If the bill amount is 500, 5% of that or 250, whichever is higher, 250. If the bill amount is 10,000, again, 5% of that you have to pay. So like that. So now we'll come to a case. Look at a case study. A credit card holder having a credit limit of 1 lakh purchased a product for 50,000 on 1st July using the credit card. If the billing date is 10th of every month and the maximum interest-free period is 20 days and interest rate charged by the bank is 3% per month, answer the following. So they have given the card limit. This 50,000 rupees is purchased on 1st of July 2023. So date of purchase. Date of purchase is 1/7/2023. Billing date is 10th of every month. Billing date is 10th. Then interest-free period is 20 days. Then interest charged is 3% per month. 3% per month. Now, the question is, if the cardholder paid the entire amount after 30 days of purchase, how much interest he paid? Look, the question is, he had made a purchase on 1st of July. He made the payment after 30 days. So when he has made the payment? Date of payment is equal to after 30 days. Date of purchase is 1st July. So he has made the payment on 31/7/2023 after 30 days. This means this is the date he has made the payment. Whether he has to pay any interest on this is the question. So you have to calculate the due date of the bill. Now the purchase is 1st July. In which bill this will come? In July bill or August bill? Because billing date is 10th. So definitely this will reflect in 10/7 bill. So 10th means 10th July bill, this entry will be there. Now 10th July, how many days you will get interest-free period? 20 days. So when will be the due date of this bill? You calculate 20 days from 10 July. 20 days from 10 July, which is the due date. You get interest-free period 20 days. That means that 20 days is the time you are getting for making the payment. So you count 20 days from 10th July. 10th July is the first day, 11th July is the second day. Like that you count 20 days. So when is that? The 21st day comes. Please post in the chat box. Nobody is answering.
30th July.
30th July. Yes, it is 30th July. Therefore, this bill, the due date is 37. Whether he had made the payment on due date? No, he had made the payment on 31st July. If he makes the payment after the due date, he has to pay interest. And what is the amount? Amount is 50,000. From which day onwards he has to pay interest? For one day interest or something else? He has to pay interest from 1st July onwards. Understand? So he has to pay interest from 1st July onwards for 50,000 rupees. And what is the amount? How to calculate? How many days interest you have to pay? He made the payment on 31st. You calculate interest from 1st July to 30th July. So 30 days interest. 30 days interest, how to calculate? Amount is 50,000 into number of days is 30 into rate of interest 3% per month. That means 36% per annum divided by 365 into 100. This is the formula you calculate. Interest has to pay for 30 days. Total interest 1479.45. Okay. Now next question. Please mute. Please mute. Some of you are not muted. Please mute your mic. Second question. If the say please mute. Okay, next question. If the purchase was made on 11th July and paid the full amount after 45 days from the date of purchase, how much interest is paid? The second question is, if the purchase was made on 11th July, the date of purchase is 11/7/2023. So will it come in the bill of 10/7? No, it cannot come because he had made the purchase on 11/7. And 10/7 will include all purchases up to 10/7. So this is made on 11/7. This will be coming in the bill dated 10/8/2023. And 10/8/2023, he get 20 days time. That means 38 only the due date. So the due date is 30th August 2023. This is the due date. Now, when he made the payment after 45 days from the date of purchase. Date of purchase is 11/7. So in the month of July, how many days? A total 31, 21 days. Then 45. 45 means 24. August 24, next day. That means 25/8 he made the payment. He made the payment on 25/8, but the due date is 38, well before the due date. So no interest. Clear? No interest is to be paid. Billing date 10th August, due date is 30th August. Card holder paid after 45 days, 25th August, so no interest is paid. Next question. A credit card holder having a credit limit of 1 lakh purchased the product 50,000 on 1st February using card. The billing date is 20th of every month and interest-free period is 20 days. Interest rate charged by the bank is 2.5. Answer the following. The card holder paid the credit card dues after 45 days from the date of purchase. How much interest is paid? See, second question. The product purchased on 1st, 1/2/2023. This is the purchase date. Billing date is 20th. So this will come in the bill of 22/23. And when is the due date of this bill? You have to calculate 20 days from this day onwards. So in the month of February, how many days? 2023 is a non-leap year, so 28 days. So February, how many days? 9 days. March, 11. Then it becomes 20. So 12/3 will be the due date. Am I correct? 12/3 is the due date. When he made the payment, he made the payment after 45 days from the date of purchase. Date of purchase is 1st February. So 45 days calculate February 28, then March 17. That means he has made the payment on March 18. Due date is 12th March. He made the payment on 18th March. So he has to pay interest. Interest for how many days? 45 days interest. So 45 into 50,000 into rate of interest is 2.5. 2.5 means 30%. 30 by 365 into 100. This is the interest calculation. 30,000 into 45 into 30 by 365 into 100. 1,849.32. Is it clear? Shall I go to the next one? It's again simple thing. 2.5 is the interest rate per month. What is the annual interest? 2.5 per month. Per month, 2.5. So annual interest, 2.5 into 12. That means 30%. Next is annualized interest or effective interest. How to get effective interest? For effective interest, use the formula 1 plus R, the whole raised to n, minus 1 into 100. We did one question in the first session. So whenever such a question comes, you take n as 1 year. And since it is credit card dues, it is monthly. So 1 into 12, you can take n as 12. And what is per month? 2.5. So R is 0.025. Use this formula 1.025 raised to 12 minus 1 into 100. This will be the annualized interest or effective interest. And plus R the whole raised to n minus 1 into 100, 1.025 raised to 12 minus 1 into 100. That is, you're getting us 34.49. We'll move on to the next concept, that is capital gain. Sometimes they ask a question on this also. See, what is capital gain? Capital gain refers to the gain or the profit realized on sale of capital asset. See, a person purchased a property or a person purchased a capital asset, some shares or other securities, and he hold it for some time and then he sell it. he derive a profit. He purchased the land for 10 lakh, sold after 5 years at 15 lakh. So he get a profit of 5. This is what the capital gain. And you have to pay tax on this capital gain. That is capital gain tax. Here the assets are, it can be a stock, means a share, it can be a security, it can be a precious metal, or it can be a real estate, landed property. So the capital asset refers to shares or securities or precious metal, means gold, silver, platinum, or real estate. And this capital gain you can divide into short term and long term. So this is short term, means in the case of equity oriented fund or UTI units, it is less than 12 months is short term, more than 12 months it is long term. Debt oriented fund, less than 36 months is short term, more than or equal to 36 months it is long term. Listed stock, less than 12 months is short term, more than 12 months is long term. Unlisted stock, 24 months, less than 24 months is short term, and 24 months and above it is long term. The period means a person, suppose a person purchased Tata Motors shares. So it's a listed share, means that is the value of the share is listed in the stock exchange. That's called a listed share. So Tata Motors share, they purchase, that is say 4,000 rupees or say 2,000 rupees. And after 5 years or 2 years, they sell it. They get a gain of say 1,000 rupees. So that is called so he hold it for 5 years. So it comes under long term. Suppose he hold it for 3 months or 5 months or 6 months. Then it is a long term. That's the thing. Now, if it is a long term or if it is a short term capital gain, then in the case of securities, sale of securities, 15% you have to charge. And all other, it is the rate applicable as per the income tax law. So look, in the case of short term capital gain, sale of securities or equities, it is 15%. And for all others, means for a precious metal or real estate, it is the rate applicable as per the income tax law. Coming to long term, in the case of sale of securities, 1 second. In the case of long term, it is 10% on the amount exceeding 1 lakh without indexation. Otherwise, 20% with indexation. So sale of securities or equities, it is 10% on the amount exceeding 1 lakh. That means, suppose the gain they have got is 1,10,000. So 1 lakh is exempted. For the 10,000 rupees, you have to pay 10%. Here it is without indexation. Indexation can be done only for government securities or sovereign bond. And then you may have a doubt what is meant by indexation. Look at this table. See, first you should understand what is cost inflation index. Cost inflation index refers to an index, a number that is announced or declared by central ministry, that means central government, CBDT, Central Board of Direct Tax, Board of Direct Taxes. And see, that is used to estimate the increase in the price of goods due to the inflation. So this started from the year 2001. So the financial year 2001-2002, the cost inflation index is 100. And every year, CBDT is announcing this, they are declaring this index, and the latest is 23-24, financial year 23-24. 23-24, the index is 348. So this, in the question, it will be given. Suppose they ask a question on capital gain, and what is a capital gain? They will give the index. You need not by heart these indexes. It's not possible also. Now, how to find the indexed cost? The procedure is very simple. Suppose a person purchased a land for 10 lakh in the financial year 2008-9, and this is sold in the year 2010. 2021 for say 15 lakh. Look, the purchase is done in the financial year 2008-9 and sale was done. So this is the purchase year and this is the sale year. Now you have to look at the index for the purchase and sale year. 2008-9, this is 2008-9. The index is 137. Now 2021, this is 2021, index is 301. Now we have to calculate the indexed cost of this 10 lakh. What you have to do is 10 lakh into numerator, the index of the sale year. The sale year, the index is 301. And the denominator, the index of the purchase year. Purchase year, it is 137. This is called the indexed cost of purchase of land. That means when they purchased this land in the year 2008 and they sold it in the year 2021, it is not scientific. If you calculate, you minus 10 from 15, that means he got a gain of 5 lakh. This is not logic because he has purchased in the year 2008. So this 10 lakh, the inflation has affected. So this 10 lakh will be something more, isn't it? So to get that value, you have to use this formula. So 10 lakh into the index CI for the sale year divided by CI for the purchase. This is a very simple formula. And then you calculate the indexed cost. You subtract that from 15 lakh. That will be the gain, capital gain. Look at a question, then it will be more clear. A house property was purchased in the year 11-12 for a price of 50 lakh. An amount of 2 lakh was spent towards improvement in December. It was sold in the financial year 1920 for 85 lakhs. Find the capital gain tax in this transaction. CI, cost inflation index 11-12 is 184. And then 13-14 is 220. 1920 is 289. So look, 11-12, they have purchased 50 lakh. Now, first is the indexed cost of purchase is equal to 50 lakh into year of sale. When it was sold 1920. So 1920, it is 289. Numerator 289. Denominator year of purchase 11-12, 184. This you calculate. So 50 lakh into, here it is, 50 lakh into 289 by 184, you are getting it as 78,53,261. That means even though you paid 50 lakh in the year 11-12, as of now, this 50 lakh is equal to almost 78 lakh because of the inflation. That is a meaning. Now, next, he had made an improvement for 2 lakh. And this 2 lakh, you have to calculate the indexed cost. So in inflation indexed cost of improvement. For that 2 lakh into 2 lakh improvement was done December 2013. So December 2013 financial year 13-14. So numerator 220 and sale 289. So 289 by 220. You will get it as 2,62,727. So this is cost of acquisition index cost. This is index cost of renovation or repair. So total cost of acquisition indexed cost is add these two 81, 15, 980. And they sold it for 85 lakh. And what is the gain? 85 minus 81. That means 3,84,012. Now you have to calculate capital gain tax on this. It is 20%. 20% of that coming to 76,802. This is the method of calculating the capital gain and capital gain tax. Now look another case. A person has inherited a residential property of value 60 lakh from his father on 2810. His father purchased the said property on 10th December 2001 for 20 lakh. He sold the property for 80 lakh in March. So see, date of inheritance. inheritance is 28/10/2010. Amount is 60 lakh. Now, date of purchase or acquisition, that is 10/12/2001. Amount 20 lakh. Now, date of sale, sold in March 2021, 80 lakh. Now you have to calculate the capital gain tax in this case. They are given the index for 2001-2, then 10-11 and 2021. Now here, this capital gain is applicable only when there is a sale of security. Look at this date, the date of inheritance. Date of inheritance, it is not a date of sale. Here, his father, the father of X, gave this property in the year 2010. So this 2010 has no relevance for calculating the capital gain. You have to look for the original date of purchase. The original date of purchase of the property by the father is 2001. So this year, this date's financial year index you have to look. And what is the index for this one? This is in the financial year 2001-2. 2001-2, the index is 100. Now, sale is March 2021. So here the index is 301. You have to take these two index. So acquisition is 20 lakh into 301 by 100. This is the formula you have to use. So 20 lakh into 301 by 100, that you are getting a 60 lakh 20,000. Now sale price is 80 lakh. So capital gain, long-term capital gain, 80 minus 60, 1980. And 20% on that, it is coming to 3,96,000. So remember, in the case of inheritance, that date has no relevance because it is, or the date of inheritance, there is no sale. Because capital gain applies only when you sell. When you sell a property, you get a gain. Here, the property was inherited in the year 2010, and that has no relevance. His father purchased in the year 2001. So you have to take the index of 2001 and the purchase price and go for the indexed purchase price. Another question is there. House for 10.5 lakh, it was purchased in January, constructed first floor in 15 and sold in 2017. You are given all the data. You have to calculate the capital gain. So January 12 is the first date, 25th January. So 25th January, 10.5 lakh. The index for that financial year is 184. Then the indexed cost, you have to calculate 1050 into 272 by 184. Next, additional construction 375. That was done in the year, financial year 2014-15. And the index is 240. Sale year index is 272. So the fact is 272 by 240. You will get the indexed cost as 425. You add these two. 19,17,174 is the total cost of acquisition. Now here, he sold the property for 25 lakh. But another thing is, he spent 1 lakh for registration. So even though he sold it for 25 lakh, 1 lakh is spent for registration. So net amount received by him is only 24 lakh. So to arrive the capital gain, you have to subtract from 24 lakh, not from 25 lakh. Okay, so 24 lakh minus 1977. So you'll get the capital gain as 422,826. That's all with respect to capital gain. It's a very simple concept. We'll move on to the education loan. Again, this is, most of you must be knowing it. Here is a quotation for an education loan. Tuition fee 5 lakh, hostel fee 2 lakh, caution deposit 1 lakh, Cost of computer 50,000. Books, uniform and equipment 50,000. Study tour, thesis, project work, etc. 1 lakh. So this is the total cost of the course. The candidate, the student has submitted you this data. Now the question is, how much amount you can consider under caution deposit? And what's the amount you can consider under other expense? And what is the eligible loan amount? And the last question is whether any security is required. So these are all the 4 questions on this education loan. Now, in the case of education loan, for caution deposit, there is a cap. Similarly, for other expense also, there is a cap. For caution deposit, the maximum is 10% of the education of the tuition fee. So that is capped at 10%. Remember, all fee you can consider, whether it is tuition fee or hostel fee, or it is library fee, or laboratory fee, or examination fee, or university fee. These are all fee. That there is no cap. You can take the entire amount. Now coming to caution deposit, cost of computer and other expense, there is a cap. The cap is caution deposit, it is 10%, and other expense, it is 20% of the tuition fee. So how much you can calculate? You have to take 10% of 5 lakh. That means it is coming to, so the caution deposit maximum you can consider is 50,000 only. So even though the estimate is 1 lakh, you can sanction only 50,000. Now next is other expense. Other expense, it is 20%. Here, 20% of 5 lakh is coming to 1 lakh. So that also we got. Now what is the eligible amount under education loan? You can grant 5 lakh. This fully you can give. Hostel fee also fully you can give. So 5 plus 2, 7. 7 plus 1, 8. 850. So total amount you can consider under, this is 7. So total 850. This is the amount you can consider under education loan. And what is the margin he has to bring in? Up to 4 lakh, nil margin. Above 4 lakh, it is 5%. So here he has to bring in 5% margin. 5% margin is coming to 42,500. So here it is. 8,50,000 minus 40,500. That means 8,07,500 is the eligible amount. Next question is whether any security is required. Coming to the security aspect, you must be knowing what is the guideline. Up to 4 lakh, no security. 4 to 7.5 lakh, you can have acceptable guarantee. If it exceeds 7.5 lakh, we require collateral security. So a landed property or a deposit receipt, something like that, a collateral security is required. LIC policy like that, it is required for considering this educational because it exceeds 7.5 lakh. We'll move on to another one. This is income on house property. Here, these terms you should familiarize. First is municipal value. What is municipal value? Municipal value refers to, one second. The rental value fixed by the municipal authority for levying building tax. So, every, whether it is a corporation or panchayat or municipality, the building, you have to pay a building tax to the local government. Therefore, for that they fix, how they fix? Based on the rental value. So municipal value means the value fixed by municipal authorities for levying the municipal tax. Fair rent is the rent for a similar property at the same location. Standard rent as per Rent Control Act. Means Rent Control Act, they says total cost, 10% of cost should be the rent. That is the standard rent. Actual rent, what is the rent we have given. Expected rent, that is higher of the municipal and the fair, subject to maximum of standard rent. So these are all the important points to remember: municipal value, fair rent. Now, look an example. Suppose the municipal value is 10 lakh, fair rent is 12 lakh, standard rent is 11 lakh, and actual rent is 12.5 lakh. Now, what is the GAV, gross annual value, and net annual value of this property? Such a question can be asked. Gross annual value of this property. How to get that? This is the formula. Higher of municipal value and fair rent, that is number one. Here, higher of municipal value is 10, fair value is 12. Higher of these two is 12 lakh. So that is one. One is 12 lakh. Then next is lower of one and standard rent. Standard rent is 11 lakh and one is 12 lakh. Lower means it is 11 lakh. So that is 2 is 11 lakh. Now GAV is higher of 2 and actual rent. Actual rent is 12.5. Actual rent is 12.5. So you have to take 12.5. Higher of 2 and actual rent. So this is the method. So here you have to take the 12.5 as the GAV, and how to get the annual NAV, net annual value. Net annual value is this minus the municipal tax. Suppose 1 lakh is the municipal tax. Net annual value is 12.5 minus 1 lakh, that is 11.5 lakh. Another example is there. We'll have more clarity. The municipal value of property is 11 lakh. Fair rent of the property, municipal value is 10 lakh. Fair rent is 11 lakh. Standard rent is 12 lakh. Municipal tax paid is 10%. Interest on loan is for 5 years ago, it is 50,000. Find the GAV, NAV, and the amount of deduction under Income Tax Act, section 24. Here is the solution. The solution is gross annual value of the property. Means gross annual value, the higher of these two. Means you got it as 11 lakh. And the net annual value, you have to calculate the tax. Tax they have given, it is 10%. 10% of 10 lakh. That means 1 lakh. So 11 lakh minus 1 lakh means 10 lakh is the NAV. So GAV is 11 lakh. NAV is 10 lakh. Now, amount of deduction. For eligibility under exemption under section 24 of Income Tax Act, maximum interest you can exempt is 2 lakh. That all of you must be knowing. You will be claiming it for your income tax purpose. So maximum 2 lakh you can exempt from income towards the payment of interest. So here 50,000. So you can take that 50,000. And then outgoing, that means standard deduction, you can take 30%. 30% of the this thing. NAV can be taken as standard deduction. Here NAV is 10 lakh, 30% of NAV is 3 lakh. So you can get a claim of exemption of 3,50,000 for payment of income tax. So this is as a way, 3, 4, 5 cases are there. You can conveniently go through it. And here the GAV is found out. This is a case study on floor space index. We are coming to the last part of the discussion. See, floor space index. What is floor space index? This is the ratio of built-up area allowed on a plot to the total area of plot. See, suppose this is a landed property. This area, say it is 10,000 square feet. And in this area, in this land, what is the maximum permissible construction area? So if FSI is 1, that means if 10,000 square feet is the total area of the plot, the construction area also can be maximum 10,000 square feet. That is the meaning. So FSI 1, floor space index 1 means total area 10,000. You can have a built-up area also 10,000. If FSI is 2, means floor space index is 2 means total area of the land is 10,000 square feet. You can have total construction 20,000 square feet. That is FSI 2. So total construction means in floors, maybe 4, 5, 6 floors like that. So certain cities, there is a restriction. So each place will have different guideline. Some thickly populated area, they will have FSI little more. In villages and all, normally FSI will be 1. So here, see, permissible, here there is a question. Based on the following data, you have to answer the questions. See, land area is 1066 square feet. So this total area is 1066 square meter. Built up area, there is a construction in this, and this built up area is 410 square meter. And out of this built up area, the carpet area is still lesser, 155 square meter. Permissible FSI is 1. Rate of land cost is 4,000 per square meter. Rate of construction cost is 10,000 per square meter. Desired rate of return is 10%. Monthly rent is carpet area 50 rupees per square meter. Usual outgoing cost 1/6. Now you have to calculate. Some questions are there, 5, 6 questions are there. First question, what is the total cost of construction? How to get the cost of construction? Remember, immediately to our mind, it may come. If the built-up area is 4 ton, built-up area is 4 ton. Now, construction cost is 10,000 per square meter. So you may say the cost of construction is 4 ton into 10,000. This is the construction cost, but you have used the land also. So you have to calculate the land cost also. What is the land? Land also 410 square meter. We have used this 410 square meter. Land cost is 4,000. These two you have to add. This plus this. That will be the total cost of construction. Understand? So total cost of construction means it includes the land cost. So 410 square meter of land is used for the construction. So 410 square meter into 4,000. 16,40,000 is the land cost, and the cost of construction is 41 lakh. So total 57,40,000 is the total cost of construction. See, because if this is the total land, you have made a construction here. This is the construction. If this is the construction, this much area you cannot use for anything else. You cannot cultivate on this area, isn't it? Here the building is there. So that is why the cost of construction includes the cost of that particular land where the building is lying. So that you have to add. That's why it is 57 lakh. Next is encumbrance factor. How to get the encumbrance factor? To get the encumbrance factor, first you have to use the monthly rent. What's a monthly rent? Here the monthly rent is 50 rupees per square meter. Carpet area 155. So 155 into 50. Monthly rent, you will get 155 into 50, 7,750. And yearly rent into 12, 93,000. So less outgoing. 1/6 it is given. Usual outgoing 1/6 of the yield. So 1/6 of this is coming to 15,500. So 15,500 is gone. Now net annual yield is coming to 77,500. So encumbrance factor is net annual yield divided by estimated annual yield. Net annual yield is 77,500. So see, encumbrance factor is equal to net annual yield divided by estimated annual yield. Net annual yield is 77,500 by 93,000. This is coming to 0.833. So the encumbrance factor is 0.833. Next question. What is the desired yield? Desired yield, here desired return is 10%. So we have calculated the cost of construction. Cost of construction, we have calculated 5,74,000. Sorry. Cost of construction is 57,40,000, isn't it? Here it is. 57,40,000 we have calculated. So 10% of that is coming to 5,70,000. This is the desired yield. Next is, what is the usable FSI? Usable FSI means This is the total plot. Total plot is 1066. Now, this is the area where the building is there. Built up area is 410. So the usable FSI means this area. How to get that? 1066 minus 40. That means 656. This is usable FSI. Next is, what is the value of the usable FSI? To get the value of the usable FSI, you take this 656 into cost of land per square meter into encumbrance factor. So it is 656 into land cost 4,000. Encumbrance factor, we are calculating 0.833. You're getting it as 21,85,792. We'll wind up with this. The vehicle loan, and because of time constraint, I could not do it. Shall we stop it here? Vehicle loan, most of you must be knowing it. It is already 10:10. So let me stop here. Okay. Okay. Some of you have already left. Any question? Any question you can ask, otherwise I'll call it a day.
Can we use a calculator in the exam, sir?
Exam, you can use the calculator, but PPT I'll be sharing. You can use only, see the scientific calculator, it's not allowed. You can use only this type of calculator.
Okay, sir.
This type of calculator you can use.
Okay.
The base model calculator.
Okay, sir.
Okay, okay.
Thank you.
Okay, all the best. Okay, bye-bye. Good night, good night.